All right. Yeah, as you can see on the screen, on the Finviz, all was red last week. Eventually, it ended in red. Um, Surprisingly, not surprisingly, I won't say surprisingly, but it was a roller coaster last week. Started week good, and then eventually ended up in red. So we'll talk about that. But today, two main things that I want to go through is look at on Amazon's valuation, different ways of valuation, different valuation from different analysts based on some of the parts valuation model. Uh, I like that. When I read through it, I found it interesting. Thought I'll share that with you guys in this our weekly discussion. The other thing I want to talk about is annuity. This is a topic which I don't think in last 140 sessions so far we ever talked about it. This is mostly around insurance products. I think I had mentioned whenever topics of annuity came up, I had mentioned that I don't have any, and I, so far my understanding, I don't like any. But this year we have seen a lot of money flowing into annuity, so that renewed my interest to go back and give a hard look at annuity, what is changing, what are the kinds of annuity, did a little a deeper dive to understand annuities. So want to share that, and of course this being a earning season, there are few earnings, and yeah, we look at macro, what's Fed doing, what's caught my eyes, what's in the news, how it impacts. That's all. Uh, those are all our general topics. Plus, if you have any questions, etc., want to talk about something else, do let me know. Right? Any new learnings you guys did? Any new thing you guys tried last week? All right, life as usual, nothing new, nothing exciting. Or maybe the markets is giving too much excitement or adrenaline rush already that you don't need anything outside of that. Bob says, I watched some day traders implode on Friday. Interesting to talk about this. I this week um I was listening to an audiobook called Flash Crash. Anyone read that book or heard about this from Liam? I think not I am. That's the book. Flash Crash. So yeah, I downloaded audiobook and I'm going through this, and it's a fascinating tale of how the market works, little bit of market structure, and one lone trader in London trading out of his parents' house was able to, I mean, that wasn't his intention, but the way he traded crashed the caused the biggest drop in a flash crash in 2010, I guess. So right. Um, it's a fascinating book to understand, and also it made my commitment towards being long-term investor, not try to do day trading, made it more firm, because the way when you're trying to do a day trade, um, you're we are competing with HFTs, we are competing with algos, and especially if you're not full time on this, you just don't have the bandwidth to do that. So, but when we're looking at a longer term, we don't compete with those. So I'm like, okay, there are hundreds of ways in which market can move on daily basis. Uh, this particular flash crash was all about, you know, not even the trades that are executed. This is all about the orders that were never executed. And till now, all our regulators were focused on who executed what. When they find any anomaly in the markets, they go and look back at, which block of trades were executed, which were the big players, and all that stuff. But this happened because of the trades that were never executed, right? But the person, he understood how the market works, and he wanted to get ahead of HFT firms. He was frustrated that high frequency traders, HFT firms, they do front running, and there are various techniques, front running, sandwiching, etc., to take advantage of market. And he was a little frustrated that why HFTs take advantage, and he wanted to get ahead of them. That's what he did, right? But regulations being regulations, HFTs are legally allowed to do that. But if you are an individual, you may not be allowed to do that. So don't want to kill the suspense. But it's a good book. I just finished the last chapter today. That was my learning from for this week, is going through this book, Flash Crash. Sachin's. So, Bob, you saw many day traders implode on Friday. Very possible. Thursday, the markets were all up as if nothing could go wrong. Maybe we front ran, the markets front ran Jerome Powell and thought everything will be okay. But when Fed chair came and dropped his bombshell, markets just went in the other direction. So, sure. And Sajjan says drops in markets help covered calls and cash sums. Well, great. Yeah. I mean, this year, and I think I've talked about it many times, some of these best performing trades have been covered calls or a delta reducing hedge trades, right? Call spreads. And as you guys know, I have moved, what was it, in July or June? Somewhere when I mentioned, trying to do a lot more on indexes, basically doing hedging trade using indices, and those have worked great this year. You see another comment. You should read Michael Lewis's books. Yeah, I have read his Flash Boy. That's again an amazing account of how these high frequency traders pay exchanges to get very close to exchanges just to enable them to take advantage of nanoseconds. I read that. I have seen Big Short movie multiple times. I haven't read that book, but that's on my list. So yeah, so this is what I did. This week, is to basically read about a flash crash. I did not know about that individual. I thought maybe he was a real culprit, but after I finished reading the book, I mean, I felt a lot more sympathetic towards that person. This lone day trader I was more sympathetic to them. I think he was just convicted to make an example out of whatever, Justice Department wanted to win, and they wanted to create an example, so they got caught. And and the funniest part is, SEC, CFTC, Justice Department, when they finished their investigation, gave a 100-page report. They all looked at, how all the trades that were executed, and came up with some reasoning of why the market crashed. The real reason why the market crashed was found by another lone trader. No, he was not lone trader. I think he was working for some firm, but another day trader who was just trying to understand why the market crashed that day. Right? So, given all the investigating strength that Justice Department have, all the folks who understand the markets that SEC and CFTCs have, Basically it is CFTC because this was S&P future, mini S&P future. They really couldn't get to the real reason, and that real reason was found by another day trader who was just curious about why the market has crashed. Maybe he lost money on that, and he went into looking at what all happened on the day in the market. So that was another fascinating find from this book. So that's my long read or long listen for this week. Cool. All right, so let's get into today's session. As always, this is all for education, entertainment. Nothing is a financial or a tax advice here or an investment advice. I don't fall into any of these categories. Not a financial advisor or investment advisor or a tax professional. So you cannot do worse than taking advice from me. So stay away from that. But use this information for your education and make your own decisions. So this week, starting with the macro side, as we all know, stock plunged on Friday. Very evident from what we see here is everything ended up on red. It almost except electronic arts, and that too, barely 3% positive, and that too on a news of acquisition. I guess there was some news around maybe Amazon is gonna acquire electronic arts, but eventually I don't think that it was denied. But otherwise, almost all sectors were red, which is this lone green in S&P 500. Okay, and healthcare company. But most of the big tickers fallen close to 4%. Microsoft is down like 3.86%. So is the Apple. Google actually down by more than 5%. Not sure what really happened on the Google side. I mean, it's an amazing company. So maybe this is where I actually use this opportunity to grab a little bit more Google, add a little bit more Google in my portfolio. Amazon down almost 5%. Yeah, nothing was spared, right? The typical defensive sectors like utilities, all green. Utilities also, sorry, all red as well. We have seen healthcare is generally defensive, all red as well, right? Again, what happened in the day doesn't define the market. Maybe people got leveraged up looking at what happened on Wednesday and Thursday. And like Bob said, some of them imploded, and then who knows what could have happened. There are million things that can happen during that particular day for us to figure out what's the net impact of that would be, right? Who knows who got margin calls, who had to liquidate their positions, right? So in any case, net is markets were all red. And it all came from a Jackson Hole meeting. After the Jackson Hole meeting, Jerome Powell came and gave a very blunt message that Fed plans to keep raising interest rates, right? And I don't know. I mean, even prior to Chairman Powell's message, we've seen a lot of other Fed governors coming and talking about it, right? Bostic, Bullard, and I think there's one more. I forgot the name. And I'm like, why don't you just shut up? This, I think in the recent years, one of the duty of Fed governors is, apart from keeping a focus on your monetary policy, one of the big to-do list is keep communicating with markets. I don't think 30-40 years ago we didn't see so many interviews from Fed governors. They'll do what they'll do, market will do what he'll do, but now everyone is taking an opportunity, coming and talking about it, what they're gonna do, whether it'll happen or not, who knows. And then the market just oscillates from one extreme to another extreme. In any case, I think it was pretty clear that the Fed pivot that market has been talking about. Market has been hoping that Fed will pivot from being hawkish to dovish. Not going to come anytime sooner. Right? That was clear from JP's statements. During his speech, he said Fed will continue raising interest rates and hold them at higher level until it is confident that inflation is under control. Right? We have to see what the next month's inflation number is, but the recent month, 8.6%, still very high. Right? Restoring price stability will likely require maintaining a restrictive policy stance for some time. And all hawkish comments. Looking ahead, future. The June FOMC projection suggests rate would rise to just below 4% through the end of 2023. And Powell is very clear, saying historical accounts warned against loosening the policy too soon. Don't loosen it too soon, because historically we have seen that really hasn't worked out well. And also, treasury yield inversion, we have seen that it is still inverted. I don't know what's the depth of inversion now, but let's figure it out. 2-year to 10-year, right? 2-year, 10-year. Is still inverted. Right? This is the most inversion of 10-year, 2-year that we have seen. Let's expand it a bit. Let's do 10 years. That's where did we? So in 2000 was when we saw 10-year, 2-year inverted as much as it is now. It didn't even reach that level in 2008, 2007, 2008. Now the yield curve inversion, it at the point where it was in 2000 crash. So it's still inverted, as we have heard time and again. Yield curve inversion is probably the most reliable. I'm not saying the perfect one, but this is the most reliable predictor of inflation, right? So it is inflated. It is inverted, and we'll see what happens. Recession imminent? Will recession come after 2 years, after 6 months, 12 months? That's what generally happens. But we also saw it inverted a little bit in 2020 and then flip back on. So from Fed perspective, that's all. Rates, they will continue to increase the rates. Now the other way to look at this is, if Fed couldn't predict the inflation in 2020, when they were all talking about inflation is transitory all the way to 2021, how can we be sure that they can predict that inflation will continue to stay so high, right? And that is why it is so funny to watch all the guests on CNBC, and a question which the host will ask you, what do you think? What's your S&P target? What's your inflation target? And poor fellas, they have to talk about something, but no one knows anything anyway. Right? So which is it's just more of eyeball. They'll talk something so that you are glued to CNBC or whatever channel you watch, essentially, but no one would know nothing. Steve says there got to be some valuation adjustment from interest rate 0 to 4%. Yes, and we have already seen, right? All the high growth value companies have crashed to the markets, right? Where they're still down 60%, 70% from their highs. So definitely those PE growths or the way we value companies have changed. And it has changed even starting 2022. Right? Now the bigger question, Steve, which we have is okay, Sridhar has pointing some technical issue. Get back to that. The bigger question here is, Today the markets mostly seem to be riding high on Fed's sugar, right? And this is like so frustrating for me. Is like, what changed in Microsoft business or Google business today that it warrants a 5% drop? Right? Nothing, zero thing. From a valuation perspective, also those were not heavily valued companies anyway. But Fed come and talks about something, and then based on what's a day positions in the market will crash 5%. These companies will crash 5%. So I was looking at, nothing has changed. Maybe I should pick some up. It is difficult thing to do, but yeah, you have to have your own opinion about it. So higher PE for companies that are not cash flow positive, this is not a right market for those. And that's why we have seen many of them have markets are unforgiving for such companies, right? We look at one earning, Peloton not working out good. Another comment I see, hello everyone, just a noob with trading, etc. But I've tried and lose. I'm just here for educational purposes. You're welcome. If this is our first session, and I generally don't talk about day trading anyway, because I'm not a day trader. I probably trade every day, but most of my trading is long, focused on a long-term investment, but use your short-term steps, which is mostly using options to achieve my long-term objective. So yeah, I don't trade. I don't have a trade which I need to open now and close it, end of a day, or maybe in a days, 2 days, 3 days, 4 days, because I'm not full-time into this. I'm a technical professional. Work my, we don't have a 9 to 5 jobs because our team spread across the globe. So consider it, 24 by, at least till 10 p.m. I can get called in or work anytime. So, but welcome you. I welcome in this. We meet every Saturday. Again, the intent is to become better investor by looking at what's happening in the market, why it is happening. We do analysis of companies, get into why this company making money, what's, how the business is, etc., etc. Sridhar says technical issue, online event link is broken for iPhone, iPad, pointing to GPS coordinates for meeting number. Oh, okay. I get it, because I think in the meeting, but where are you joining it from? If it is on a, okay, I get it, because I think on a, maybe on a meetup link, the location I put in is this Zoom, and that is why it's just taking you trying to go through the GPS. Maybe I'll see if on a meetup there is another way to put it somewhere else. I mean, obviously it can be the meeting description, but if there's something that is visible up front. So thanks, Sridhar. I'll see if something else can be done. All right, looking at housing, interesting tweet is in Jan 2021, 30-year mortgage was 2.65. Average new home price in US was 401k. Today, 30-year mortgage rate is 5 point something percent. Average new home price is 500 plus K. Assuming a 20% down payment, which is what your normal mortgage loan would be, that's a 95% increase in monthly payment. This upset whole calculations of running your household. Right? Now, another one which I saw was US mortgage payments as a percentage of income higher than at the top of the subprime bubble. That was really eye-opening for me. These numbers make sense. Number one, if your EMI monthly or your monthly mortgage is almost double, as a homeowner or as a prospective homeowner, you start thinking twice about should I even now move forward with my decision to buy home? Should I continue to be in the market? Because now I have to decide from whether to eat or whether to pay my mortgage. Yeah. 10%, 15%, 20%, 25% increase, maybe you have that buffer. But if your monthly mortgage is now becoming double, let's throws away all your planning out of the window, right? Mortgage payments as a percentage of income, this is, almost 25%. Right? The affordability is really going down because of increase in mortgage prices. Number two is, of course, the housing prices, right? The result of that, Steve said, the higher interest only affects new buyers or the buyers who may want to sell and move into a new place, right? So if I were to sell my house, of course, then I have to buy a new one. I'm not going to do that anymore. Right? So then you won't see, more homes being put in market, because the existing home sellers, if they have to buy a new one, they'll basically be postponing their purchase, right? For me, it doesn't make sense to sell a home on which, let's say, have a 2% or 3% interest and then turn around and buy another one at 5%. So it's a double-edged sword. This also means that the homes coming onto the markets from an existing homeowner will become less and less, because they can't find a new place, or for them to buy another house to live in becoming more and more expensive. So the result of that is home buyers are backing out. Roughly 63,000 home purchases agreements fell through in July, which is equivalent of 16.1%. So 1/6 of the contracts fell through, right? Which is the highest since March 2020. I can understand March 2020. You were not ready. Markets fell down 30%. And at that point of time, if you were thinking, yeah, I think I can do this down payment and move forward with my contract and the market, because I can sell my stock or my company shares, I can sell and make some money out of it. Or, my 401, you should take out money from 401k. My brokerage account is, all good. I can sell some of my shares to do a down payment. But then you see that crash of in March. I understand that. You'll renege from your contract. You'll not go through the contract. Right? But now, it's as high as what we saw it in March 2020. Right? But the economic situation is not that bad. So there are some interesting stats around housing. Still hot. I think, my opinion, still a little more weakness that we could see in housing market overall. So if you are in the market to looking for a house, maybe you may want to, wait for some more time, see how the market behave. Right now we are seeing prices have started to cool down in the hot markets, in the markets like Phoenix, Idaho, Boise, Phoenix, Austin. The prices have started to come down, and the inventory has gone up by a lot. So that should in future bode well for the buyers. All right, but another interesting news is from housing market is Adam Newman, the fallen boy or fallen CEO of a company WeWork, is back in the market with another housing company. So company name is Flow. So that's why I'm like, the WeWork didn't work. I mean, you guys are aware of what happened with WeWork, from a valuation around $40 billion where they were planning to come to the market. Right? Even and it couldn't go IPO even at $8 billion. Right? And then eventually it went IPO through SPAC. I think it was last year. What's their WeWork valuation now? It's now at less than $4 billion. Right? Adam Newman was thrown out of WeWork, but he got a nice handshake, $1 billion, $1 billion worth of severance package. That's what he got when he was thrown out of WeWork. And you can go back. I think there is is it on HBO? No, not on HBO, because I've seen that it's probably on a Peacock or maybe one of these streaming services. There is a a TV series around WeWork. There is a TV series on the Dropout, which is for Theranos. There is another one around WeWork. I forgot what's the name of that is. We Crashed or something like that. So if you aren't familiar with WeWork, maybe you can go and watch that. But it's a fascinating account of the various excesses that happened on WeWork, as if nothing could go wrong, and that it just imploded. It was just a age-old rental business disguised under garb of a technology, high-growth tech company. Right? So after imploding that company, Adam Newman is back. And not only is back, he's back with the bank. He's able to raise $350 million at a valuation of $1 billion. And by the way, this is not the first startup that he raised money for after he's back for his inning 2.0. The another one that he raised money for was Flow Carbon. So I don't know. Now he's fascinated with the Flow name. So Flow Carbon was, again, so that's a startup backed by Adam Newman, which would track carbon credits on blockchain. Right? We won't go more details in that, but this company was able to raise $70 million. But this one, the Flow, raised $350 million at a valuation of $1 billion with a $0 revenue right now. So, but you might be wondering, Andreessen Horowitz is a very well-respected name in Valley, right? They've been investors in a lot of tech companies. They are probably the biggest investors in so-called disruptive technology around Web3, around crypto crypto companies. So why is Andreessen Horowitz investing $350 million in Adam Newman's real estate startup called Flow? Right. So he did give his own reasons. It's in the blog post. Maybe we'll quickly go through that. But there was a lot of backlash on this investment. So if you look at the tweets or the LinkedIn post coming from CEOs of some of the other companies, there's the backlash is around, if you are white male, it is very easy to raise money in Silicon Valley. But another CEO, even doesn't matter if you have if your previous venture imploded, like the way WeWork had imploded. But if you are a CEO of a color, or if you are a female founder, they won't have been given $350 million. So a lot of a backlash was around that, in terms of how Silicon Valley VC firms. Now, I don't know how much is the truth or not, but again, people have opinion. Everyone has a right to express that opinion. How VC, the whole VC group and the VC gang is still typically white male old boys a club, right? And anyway, that's why there was so much of backlash, because I think the community was baffled at fact that Adam Newman is able to raise $350 million after what he has done, what had happened with WeWork. But let's see there was a question, right? There was a question saying, what's the problem that Flow is going to solve? Steve asked that. So let's see. Obviously, Mark Andreessen is a smart guy. He probably would have seen some of what the problem that this company is going to solve. It is a little long read. Is it okay if I can go through this maybe rather quickly? Because you would see the reasons why Mark Anderson would want to invest. But then on top of it, we should add in a layer of our own analysis to see, does it even, will it work or not? Again, very profound lesson that I have learned after seeing many of these companies just implode is, doesn't matter how smart the VC. So my default assumption, all VCs are very smart, right? Because they have been either operator, they have been either previous founders, they have run some previous companies, they have been inventors, they understand it, right? What we need to add to the layer of that is what happens if they get too much of money. Right? I saw that with many companies who in which SoftBank invested. We'll probably touch upon that. Now I'm seeing bigger and bigger VCs, if they have more and more money, sometimes you just don't know where to invest in, right? You have tons of money for Mark Henderson, A16Z, 350 million, maybe peanuts. Right? For us, it might be, oh, that's probably is investing such a big amount because that's where it looks like this is a great opportunity. But I think that's additional color we need to add on to when we're trying to do any analysis. So let's quickly go through it. Our nation has a housing crisis. So maybe this flow is it wants to solve this housing crisis, right? Skip that one. First model. So there are two historical models in the housing crisis. The first is you own a home, you call your own. Typically multi-decade mortgage, we all know it, near your current employer. So if you can find a house, then most of the cases we're not building those houses, especially in Bay Area, near an employer. But if you can find a house near your employer, if you can afford that house, if it is within your means, and even then you're now stuck because once you buy the house, you can't move. Your mobility is restricted. Everyone who owns a house near your work location, if you have to go for work, taking another job becomes a problem, because you might have to travel more. The second model is you rent an apartment. Right? Gives you more mobility, but it is a so less experience. Do you even meet your neighbors? Much less have any friends in your complex. So essentially it's talking about two things. Either when you buy a home, you get engaged in a community because you're there for long. You go and talk to your neighbors, hopefully. Invite them for housewarming, invite them for common community functions. But if you're renting an apartment, maybe you don't own that, you don't have your sole equity in it, and you don't invest much into that. You're just there as a guest, right? I think maybe in now drop the impact of what the post-COVID world will do. Many people will live in places far away from their work because of work from home. As a result, they will experience much less, if any, of the office social bonding. Okay, I don't know where he's going. So if you're working from home, you don't have those official social bonding. Plus, if you're now renting, you don't have those bonds with your neighbors as well. So essentially, your living experience is not that great. So what else? The residential real estate world needs to address these changing dynamics. And yet, virtually no aspect of the modern housing market is ready for these changes. So we are excited to partner with Adam Newman. Let's see what he wants to do. Adam Newman is visionary leader. Let's give that time. What does Flow will do? We think it's a natural first after we work. Let's come here. Shelter is one of our most basic needs. In a world where limited access to home ownership continues to be a driving force behind inequality and anxiety, giving renters a sense of security, community, genuine ownership has a transformative powers for our society. Okay. Is it rent to own? Because genuine, when I talk about genuine ownership, I thought maybe it is rent to own. Let's read forward. When you care for people at their home and provide them with a sense of physical and financial security, you empower them to do more and build things. Solving this problem is key to increasing opportunity for everyone. Okay. All smoke and mirrors so far. I'm still trying to figure out what is Flow doing. This kind of a mission is heavy lift. Only through seismic shift in a way industry relationships are structured and a mechanism through which the value is delivered can we hope to address the underlying problem of the current system and build a solution. This means rethinking entire chain. So far I haven't found anything around what he wants to do, really what Flow does. So let's go to the Flow website. Maybe we'll find some information. So now this scares me because all I've heard are the words that I heard when we were where is the Flow website? There we go. Oops. Oh no, this is different. All right, it's even difficult to find a website for Adam Newman Flow. Let's see if it shows up this. Is there a website? No. Anyway, so my understanding so far looks like the rental sector, but instead of you going and staying in an apartment which is vacant and trying to set everything up, it could be rental with a huge community. The way he tried to transform the commercial real estate market by creating those we workplaces, which from a business side is still good. I mean, it is a verb, right? If I want to go and rent a desk or rent an office, we say, yeah, let's meet at a we workplace. We don't say let's meet at a Regis place, right? So that did revolutionize the or made this commercial short-term rentals. It did revolutionize that, but the financials were way off. That's where the WeWork found. But looks like he's trying to do the similar thing on the rental side, in which maybe I actually own a stake, because it talked about genuine ownership. Maybe I own a stake in a stake in an apartment, not an individual apartment, but in a flow, which gives me an ownership of an apartment. But I can choose, I want to stay 6 months in an apartment A in city A. I can go and stay there for 6 months. Probably hopefully it's all furnished. That's where we talk about we'll have a nice community. It will be a good experience. And then if I want to move to apartment B in city B for next 6 months, I can move over to another apartment. Right. So from as a renter, the experience is much better. Plus at least I have a ownership. But I don't know, how is it different from a timeshare? Maybe timeshare is you have only limited number of days and you have a blackout periods. Maybe this could be different. But again, we don't know more details around it. All I know is Adam Newman, from the $1 billion that he got as an exit package from WeWork, he bought a bunch of properties in certain cities like Florida, etc. Maybe in Miami, in few other cities in Florida, and maybe some other places. And those are those communities, rental communities or apartment communities that he's going to revamp and put under Flow. So for now, for me right now, I'm not excited, but Why did Mark Anderson give $350 million? I have no idea. Okay, so there it says Flow is expected to launch services in 2023. So they don't even have any services. It hasn't disclosed the details of the business, but the plan is to have a network of buildings where people could rent room in shared furnished apartments. Okay, it's renting a room in a shared apartment. This is almost similar to what was WeWork, but instead of a residential, that was more focused on, hey, you also got your office in there. But I don't see, I'm not excited about that, hey, they've turned the corner. I think I'll still take with a lot of skepticism. But the bigger question is, why would Andreessen Horowitz invest, right? So here's a little bit of my thought process is bigger the fund is, you as an investor, as a VC, you would want to look at an investment which or want to look at a project which needs big amount, right? Because these investors, VCs, also have to return money to their LPs. So if they want to return, let's say 20% to their LPs, right? If they fund, let's say this company, whatever, Andreessen Horowitz has got $3 billion available that they raised from their LPs. They need to deploy that $3 billion. Either they can find 10 companies like WeWork, who's looking for close to $350 million investment. Or if they're looking for a smaller companies, they're, for $35 million, they'll have to find 100 companies. Lot more work involved on the VC side. Yeah. So it's easier for them to make a bigger bet, because if you have to deploy that company or deploy that funds quickly, you can't vet 100 founders. Right? So, and this is not just on A16Z. This was exactly the other thing which also, does what SoftBank does. They raised $100 billion through a vision fund. And after that, we saw huge investments from SoftBank everywhere across the world. Right? Remember, all these VCs have investors who are also waiting for return. So unless they deploy their capital, they can't expect any returns. So the idea is always to deploy their capital faster. Second thing is, why not give a second chance to the founders, right? Now those founders, Adam Newman has become more experienced. He has gone through fire in WeWork. Maybe he's learned lessons from it. And given, even given all the gotchas around WeWork, we still have to credit him for creating a company that at some part of a time was valued at $40 billion. And that was valued at $40 billion, not because of Adam Newman's fault. It was because market was crazy at that time. But he did change the commercial real estate market. He created a new verb in terminology of people who want to work. Let's go to WeWork. And we don't talk about let's go to a rented workplace. Let's figure out a WeWork place to meet. Right? So this is where we're seeing, and like I said, US SoftBank also had the same methodology. And what I see is A16Z following the similar stuff. So that's why they were reason of why they've invested in it. Right? All right, housing markets not great, but then we saw this new investment in housing market that took everyone by surprise. Overall market perspective, not good. Almost like we already looked at, everything fallen close to 4%. That shows up in the numbers. I don't know. Where do you think we are in this cycle? Capitulation, discouragement, or are we still in panic or despair? I think from my perspective, again, this is just my thinking, maybe we are still between panic and capitulation. So not yet at the bottom, but who knows, right? These are just the guesses of individuals, and we could very well be sure, we are not here. We are not here. We are not here. We are not anxiety. We are not in denial. I think we're beyond fear and despair. But where are we in this? Difficult to put our thumb on. Looking at a fear and greed index, I swung back to fear. Last week, I think it was close to 55. A week ago, it was at 51, and then it's back into fear based on what we saw in the market. I'll skip that. S&P sector overview. Overall, it ended up -4%, as we know. I think except energy, all sectors were down. And from a next week, gosh, still a lot of tech companies are still reporting. Right? If I really look at it, CrowdStrike, I want to pay attention to in my portfolio. HP has been doing good in recent times, but this is a stock that I don't own. But could it transform itself like Microsoft has? Time will tell. Something, but you may want to just keep an eye on. Okta, Viva, C3AI, Sentinel-1. These, I think this Wednesday after close is all high growth, extremely high valuation companies. So if they report good, might see a huge jump. If not, you'll see like drops that we have seen, 15%, 20% drops, things like that. I think, yeah, that's all on the next week side. All the big companies have already gone through. Now we are seeing those little smaller market cap companies going through their earnings. All right, what else on the news side? Student loan. I don't know what our government is up to, but between 10K to 20K of the loans would be forgiven. Some people are way against this because this is gonna cause inflation to continue. We just passed an Inflation Reduction Act, and now the administration is taking another measure which will basically nullify the impact of Inflation Reduction Act. The savings of $700 billion that was talked about, now we're giving away $350 billion in student loan forgiveness. So I don't know why not addressing it at the root cause, which is how to make sure that the cost of education itself is lower. Maybe make the student loan bankruptable. We have so many other loans that are bankruptable except the student loan. So there is no incentive for any of the colleges to reduce the cost of education because they are guaranteed their money. And now looking at all this forgiveness, I mean, personally, I'm not in favor of this. This is like, when will administration let individuals take ownership of their own actions? Great. If you have taken a student loan, you understood the terms of the student loan, what do you need to pay for? Make sure you can earn accordingly. Based, if you are doing a particular degree or going to a particular college, make sure you understand the economics of going to that college and what the loan you're getting into. And yeah, as an adult, you make that decision. If you're not able to pay off, like for all other loans, government shouldn't come to your rescue. But I don't know, this is, to me, it looks like more of an election agenda. It was an election promise for President Biden. So he's just ramming it through his executive order. Maybe this will get challenged in the courts. Who knows? But yeah, personally, I don't know. You might have some different thoughts, but I believe we should let people have the taste of their own actions. Otherwise, it's just like kids, right? You keep feeding them sugar. Long term, it's not good for them. Anyway, Let's quickly look at earnings, and then we'll jump on to Amazon and Annuities. And then if you have time, maybe we can come back to some more stories. Before then, any thoughts on student loan? Because this student loan, at least I saw in Twitter, it's a polarizing topic. Right? Some people are in favor of it, while others are against it. And there are people, there's a question of moral hazard also here, right? What happened to those who actually didn't go to colleges they couldn't afford because they didn't want to take student loans, or those who actually worked their asses off and did 2 jobs to pay off their student loans? What would they feel? What next time, what would be their recommendation to someone who's going to college? Right? So different view or opinions over here. Let's look at it quickly at some earnings. Zoom shares got punished after earnings. Let's look at what was the market. ZM shares after earnings, shares were down almost 17% because markets didn't like that the growth slowed down from 12% to 8%. Right? Not just the growth, the revenue growth slowed down, but their expenses were really high. So the net income fell down to 46 million from 317 million. That's a huge change because a lot of money was spent on sales and marketing. Guidance, they also lowered their guidance now they gave the guidance between 4.3, or let's say it's $4.38 billion. So market didn't like it. This was a growth story. It is still growing, but it is growing at much slower pace. So stock got punished, 17% down. It did add, again, from the growth of their enterprise customers, from where they get most of the money, that was up less than 3%. Overall slowness in growth, and that's why markets didn't like it. As we say, a lot of students can't afford the college cost and doesn't offer any jobs. This causes cheap employees for life slaves. Now, the lot of students can't afford because colleges just keep their education cost high. They are not focused on, let's say, matching the education fee, matching the fee with the level of education that they provide, because they know that they can charge anything today for college, because even there is no market forces that will force these colleges to look at the risk factors around what's the risk if I am, if I'm making, someone is taking a loan to attend my college. The loan providers don't take any risk factor into account because government either will bail them out, or number two, you can't bankrupt this. Right? So whether you pay through your nose or whether you probably will have to cut down on your food, but you still got to pay your student loan. What if we, instead of doling out these forgiveness programs, maybe make a student loan bankruptable? The companies that are offering loans will think twice to make sure, okay, what kind of degree you're going to get. Okay, they will do their own due diligence before offering the loan. For buying a car, they'll check your FICO score, whether you can afford $20,000 car or not. And you may get denied for the car for a $20,000 loan, but you will be given a $200,000 loan, student loan. I just can't understand that disparity. It's so make it more market driven. If you allow it bankruptable, I think it will take some time, but once you start to factor in the idea that if you don't really deliver the goods, people won't be, as a student and as a loan provider, they'll start thinking that getting that into calculation when making loans. Colleges will have to either increase their standards of education, which means people can get good jobs when they graduate out of college, or they have to reduce the fee. Today, it's all fed by subsidies, so they have zero intention to reduce the fee. Right? So why would? And number two, it will also force students to pick up the right, you know, what do you call degree, which is bankable. The degree that you can the area you can graduate from and can get a job, which is higher paying job than being a barista at Starbucks or working minimum wage at Walmart. So, but I guess it's more of an election stuff. We're not gonna, they're not addressing it at the core level. Sridhar, or just make higher education more affordable like other countries. I mean, I think what administration over the different, presidents have done, both blue and reds, have addressed it in a wrong way. They're making it affordable by just throwing money at you. Giving your loans, which are guaranteed by federal. So, student can get a loan, and institutions have no issues in admitting you because they know their loan is guaranteed by federal government. But that's the wrong way to address it. So anyway, enough on that. Let's look at Snowflake. After the disaster result from Zoom, Snowflake came up with the result that their top line grew 83% year over year to almost $500 million. So this company continues to surprise me because quarter after quarter, they've been delivering these stellar results in terms of a growth. I don't own this yet, but I've been watching because I've always been thinking, how long is this sustainable? But it continues to surprise me. The best metric which they have is a net retention rate, which is 171%. This is the company of all the SaaS companies that I know of. This is the company which has got highest NRR. Again, if you're running a SaaS company, it's a very important metric that investors will look at is how much of your existing customer increasing the spend with you year over year. 177%. Oh, sorry, 171%. On an average, you would see this anywhere between 13 to 20% is good. Up to 30%, 20, let's say up to 20% is norm. From 20 to 40% is good. 170% is crazy. It's crazily amazing, right? But they keep on putting these numbers year over year. Total customer count also grew from 6,300 to 6,800. Guidance was also better. Now they're getting between 1.91 to 1.92 billion for the full year. So what is Snowflake's valuation? All right, no worry, no wonder shares actually jumped whatever 20%, I guess. It is $66 billion, still pretty expensive, still not making any money, and from price to sales, still very expensive. Even after putting in, maybe I could say for a company like Snowflake, which is putting up such a higher growth number, that's where they are able to command this 46 price to sales. But this was an amazing result from Snowflake. Completely opposite was Peloton. The revenue fell on 28%. Used to be the darlings of 2020 and 2021. Now the stock is languishing. Their connected fitness, which is your treadmills, your Peloton bike, all the stuff, it dropped 55%, like cut into half, more than half. And worst thing is that business is negative 98.1 gross margin. So if you buy a Peloton bike last quarter, you actually drained Peloton. They didn't make any money. In fact, if you bought it for 2,000, they almost lost $1,800 or $1,900 on that. And no wonder now they are announcing sales on Amazon. So rather than being an exclusive player, you can only buy it at exclusive locations. Now they're tied up with Amazon so that they can sell those bikes on Amazon. Only good thing in Peloton business is their subscription business, which is, once you buy a bike, you also buy their monthly subscription of any fitness programs. That subscription business was the only good thing. The revenue was up 36%. CEOs focus is forget about this whole great bike and all that. End of a day, I think now they've realized that they're super pricey bikes. No one is going to fall into that trap anymore. Probably the number of people who could afford those bikes, they already reached all the markets. So now the focus of the management is on subscription, grow the revenue, and not really worry, focus more on selling the hardware. So that's going to be the focus of Peloton. Now, interesting thing about Peloton is the stock used to be at some point of time Peloton. I guess this is down 90% or so. Some part of time it at $860. It's down even more than 90%. Right? From $60 billion of valuation some part of time, it is now less than $4 billion. If the strategy of focusing on subscription and not on hardware, essentially cutting down the cost of managing inventory, clearing up your hardware, and rather focus on subscription, if that strategy work out, this could be a turnaround story. There are also gossips in the market or rumors saying maybe why not Amazon buy it? Could it become an acquisition target? How about Netflix? Netflix already has a streaming service. This could be another a diversification for them. I'm just guessing. Right now, everyone is just waiting to see if this business even survive or not. Right? So far, all the signs are maybe this will just go bankrupt. But they did hire a new CEO who's making a lot of changes. They cut down their employees. They're cutting down their cost. Now moving towards through a subscription rather than focusing on the expensive hardware. Maybe if this works out, this could be a turnaround story. And now at $10 with the price to sales of 1.1. Remember, Snowflake was 46. This is 1. Could this be a value play at this point of a time? If and only if you believe that the turnaround strategy will work, you may want to look at this. Again, not an investing recommendation, but something that caught my eye was, if it is a turnaround story, is this cheap enough? At this point of a time, looking at these numbers, from a valuation perspective, looks cheap enough, but it is cheap for a reason. Can this new CEO execute on the new strategy? That only time will tell. So that's the risk we have to take. Any questions on earnings? All right, otherwise let's jump on to, I'll skip this. Let's jump on to two main topics we want to talk about is Amazon and then the annuities. Which one you want me to go first? Talk about annuities or Amazon? Or no preference? No choice? Shall I just go with the flow? All right, I'll stick to flow. not Adam Newman's flow, but the flow of my document. All right, let's look at Amazon stock a little different way. So stock is down 33%. Even now it is down even more. I think now it is close to where it is Amazon. Where Amazon stock is? I don't even know. I mean, this is, as you know, this is one of my top 10 position, but I don't know on day-to-day basis where it is. 130, right? Close to 130. Still, it is, let's say it's down more than 30% still from its all-time high. Investors know Amazon mostly as a retail operations because hey, you see those Amazon boxes every day, one box will arrive. I'll see some Amazon box sitting in front of my doorstep. I don't know what my kids and my wife keeps ordering, but that's what we know Amazon about, right? It's a retail commerce operations. Those who are little savvier in the market have been watching Amazon, look at their earnings results, or those who are in technology sector knows that Amazon Web Service is the big 800-pound gorilla behemoth in providing cloud services. This year, the cloud service will be around 15% of total revenue, but it is more than 100% of its profits. Right? There is no money that Amazon makes by selling the goods. They deliver the goods on the same day, next day, 2 days, but they don't make any money through that operations. Not surprising. That's what, I mean, it has taken them, 22 years, and still it is not profitable from an e-commerce perspective. All the money is coming from their AWS business, which is their cloud business. AWS growing at 30 plus quarterly clip. Right? Still very healthy growth, not where it used to be. This used to be a business which will grow 50% year after year. But once you reach a big base like what AWS has, it's not possible to grow at the same rate. But still 30% very healthy rate. Competitors are catching up, like Azure from Microsoft. It's not as big as Amazon AWS, but that's growing at a 46% rate. Right? But this is way, I mean, has way more market share than any of the other player. Looking at Amazon valuation today, I mean, it's all about cloud. The operating income in this, it's expected to make $26 billion in operating income. Whereas the overall Amazon is expected to make $17 billion. Right? It means the rest of the businesses of Amazon will lose almost $9 billion in operating income, but all is sponsored by AWS. Right? Overall, from a revenue perspective, e-commerce is the biggest one. Buying and selling of goods, us buying the goods and giving favor, doing favor to Amazon. That business is almost $350 billion. Next comes AWS, which is $80 billion run rate. That's a quick chart on Amazon. While the sales growth on e-commerce is slowing down, overall, when we reviewed Amazon's quarterly result, right? Overall, Amazon recent quarter results, Amazon grew by 7%. Right? But their cloud business is still growing at a healthy clip of 30% plus. So this is the driver behind most of the Amazon valuation. But is this the only? What analysts do, and one of the way to look at their valuation is doing sum of the parts. So let's look at some of the other parts that we've talked about, right? Amazon has got advertising business, which has now annualized revenue of $40 billion. We spent a lot of time in this when we reviewed Amazon's earning results, because this $40 billion is 4 times Twitter plus Snap combined. Now, the challenge for investors is how to value Amazon. Today, Amazon overall valuation is what? $1.3 trillion. It's got the most revenue from e-commerce business, most profits from AWS. It's got a $40 billion worth of advertising business. It's got Whole Foods, grocery retail business. It's got autonomous driving in Zooks and whatnot. It's got multiple businesses. So how to value them? One of the Wall Street favorite strategy is do sum of parts, right? Make a list of all the things that company own and put a valuation on each part. AWS bringing in $80 billion worth of revenue. If AWS is a standalone company, what would it be worth? Now I can find some company, I don't know, maybe not on AWS, but then we can find out how the other companies may be valued, for this business. Or advertising business, then we can find out the companies like Google's, etc., which derive most of their valuation from advertising. What price to sales multiples do they get? Then it becomes easier to, first of all, you cut down into parts, then you value each parts using the traditional valuation methods, and then you add it all up. That becomes your sum of the parts valuation, right? So for some Amazon business, appropriate companies are hard to find because there are no, for example, public cloud, there's no pure pay public cloud. Amazon has got AWS plus other businesses. Microsoft got Azure plus other businesses. Ad business is valuable, but it's linked to their e-commerce business, right? The subscription business is Prime, which has a Netflix-like video business, plus also has a Spotify-like music service. So that is it. Valuing Amazon becomes difficult because of the business is so complicated. Now they got in One Medical, which is the medical service offering. Now they're also bidding for Signify. Now it's got a healthcare company in it, right? It's got a telemedicine company in it. So how do you even evaluate? So then plus they have a lot of these other bets. MGM, they bought it for $8.6 billion. This is a big movie studio. Zappos, which is a shoe retailer, $1.13 billion, and so on and so forth. So how does all these, what impact do all these have on Amazon business? So looking at this sum of the part valuation, 4 analysts put together their valuation. You can create your own or pick which one you associate most with, you think makes most sense. Needham analyst Laura Martin, from her opinion, the value comes from its media business. Maybe because she is a media analyst, I don't know. She values Amazon Video, Prime Video, Amazon Music, Twitch, which is their gaming, and advertising at more than $500 billion. So her opinion is Amazon got only 2 businesses. One is AWS, another one is advertising. She values AWS 650, advertising at 500. Total gives you 1.15 trillion, which is little less than where Amazon right now, but not too far away. But this doesn't include e-commerce. No valuation from e-commerce perspective. So that's who's Laura. Let's look at her valuation. Okay. Yeah, Prime 100, advertising $374 billion, Prime $133 billion. There's a breakup. Overall, 1.2 trillion. Let's look at the next one. Same day or not at the same time, different analysts had different valuation models. That is why you can't depend on any one analyst. You need to do your own due diligence. Time and again, we are seeing that the estimates could vary more than 100%. Then I'm like, guys, you guys, many of them are CFA, do this for living. And if your error rate is 100% as an analyst, as a community, then, I mean, we as a retail investors can also do maybe a better job than that. All right, looking at the twist analyst, He puts a value of more than 500 billion on third-party retail service business, add 172 billion for first party. Subscription business is over $100 billion. AWS is at 860 million, 7 billion, including multiples of 30 times. Right? 30 times your multiple brings you 867. That brings to $1.7 trillion. All right, JP Morgan. They value retail at 950 billion, AWS $1 trillion. What's a detail of that? Why did it say this? Okay, it pegs the value of AWS at 20 times his estimate of 52 billion. So in 2023 earnings before basically EBITDA. So 2023 EBITDA will be 52 billion. Your multiple you're assigning is 20 times EBITDA. So your AWS itself is got $1 trillion, and the multiple on the retail is 1.25, which is fair, I guess. 1.25. From that perspective, valuation is 2 trillion. The most aggressive come from Redburn Research. It's based on growth expectations, which is way higher than what the Wall Street has. Overall valuation, if you look at AWS, is actually 2 trillion because in their opinion, market is still very conservative when they're evaluating AWS. So he uses his estimate and overall comes around close to $3 trillion. Now from 1.2 to 2.8, right? It's like 150% variations. If we were doing any experiment and we have such a huge variation, we'll actually discard that experiment saying something has gone horribly wrong. But on Wall Street, estimates, everyone still thinks that these people know what they are doing. As a community, maybe individuals probably get it right, but as an overall community, they're no better than I think what you and we can do. Provided we learn how to value these companies, we learn how to find the businesses, we learn a very few things of how to read P&L, some financial statements, because these are way off from one another anyway. So that's around different valuation numbers based on some of the part valuation from Amazon. Now, based on what you think, what could be the growth on AWS, or how much the cloud business should continue to grow? Because clearly Wall Street doesn't have a common opinion or around it anyway. So why listen to Wall Street then? You can pick your own estimate of what you think will grow, looking at what you think Microsoft is doing, how other businesses are growing. Based on that, you can come up with whether Amazon is a good buy for you or now, and make a little more judgmental call on it, rather than depending on, maybe you just looked at this person's estimate and did not know about $1.2 trillion. Right? You could be overshooting, who knows? So, but it was an interesting way to look at some of the part valuation and how even on each of these Wall Street firms have a different valuation even at the parts level. So that was my new learning from last week. Any questions on Amazon? Who holds Amazon? For me, Amazon is one of my top 5 positions in portfolio, and I'm happy holding Amazon. My own, I don't have a valuation, but I think they will continue to survive and find a new growth areas, new opportunities. Advertising just sneaked up from nowhere, right? Now with a new, I think recently they made another announcement. They're gonna do away with Amazon Basics, their in-house brand. And while in a short term, you may think that, gosh, that business didn't run well. In-house brands are generally, if you look at the retailers, when they come up with their own in-house brands, they have a higher margin because they can control the cost, right? So they generally have a higher margin. So first, when you hear about Amazon saying, hey, Amazon is actually, this will discontinue its Amazon Basics brand, the first reaction could be, oh, it's bad for them because they are killing a bird which is, they're killing the business which has got a higher gross margins, right? Let's dig deeper and think more about what else Amazon has done. What killing that business, what else will it provide to Amazon? Number one, a lot of regulatory pressure on Amazon comes from the fact that Amazon is a marketplace for retailers, but it has got all its own products also. Now, with killing Amazon Basics, a lot of that regulatory scrutiny around monopolistic practices that Amazon favor its own brands over the merchants, that case is no longer there because Amazon won't have any brands. Number two is because now Amazon doesn't have any one of its own brands, but and the fact that Amazon advertising business has become much more stable now. Each of the other the remaining sellers now will have to compete against each other and will end up paying advertising dollars to Amazon. Right? Now, if there were certain markets in which Amazon seller had just exited those markets saying, gosh, we can't compete against Basics, because it's always, Amazon Basic brand will come up on the top and customers always buy them. It's not profitable for us to operate in that particular category of the goods, right? Now you will see those buyers not only just coming back, sellers coming back, but also competing against other sellers. The way you compete is you advertise, and where they will advertise? On Amazon, which will basically feed into Amazon's advertising business. So overall, killing that Amazon Basic business, probably not a bad idea, but turn out to be a good thing in long term. But if you just look at the superficial, maybe you might hear some news around, oh, wait, it's going to hit their gross margins. Peel one layer, you might find a different way to look at the same action. All right, let's talk about annuities. SP says he hold Amazon. That's it, only one Amazon. Maybe many of you might hold it Amazon indirectly because you have exposure to S&P 500 in your retirement portfolio. If you have, those standard age-based retirement portfolio in your 401ks, it's pretty common for them to have a large chunk of their investment in S&P 500. So, cool. All righty, ready for annuities? This is going to be the last topic for today. But before that, let me ask a question. I don't own any annuities. Anyone who owns annuities? Because I don't have my own experience with this, but I'm just seeing who owns it and probably can talk a little more based on their real practical experience. No annuity holders? Anyone interested in annuities? Should we even go through this topic? Any? Okay, to continue on annuities, or should we get back to what else we saw in the markets? Because I skipped that section, but I wanted to cover annuities. It's a lot of money moving, annuities in this year. Okay, I see one. Okay, say continue with annuities. All right. If there is 1 versus 0, 1 wins. All right, so I will continue with annuities then. SP says no. So I don't know, was it to skip back to that one? All right, let's continue with annuities. A way to hedge inflation. I saw a topic saying maybe annuities is looking an attractive option to hedge against inflation, right? Current times are the boom times for annuities because they are providing savers and investors not only the stability, and I'll touch base upon what an annuity is, but annuities not just provide stability, they provide stability for because they pay out they have a fixed payout. In a year when the stocks and bonds nothing are performing, a lot of money is now flowing back into annuities because hey, we can actually get some stable returns from it, right? Sales of these hybrid insurance products, and mark this for hybrid insurance products because we'll talk about this. They have surged this year. This is the report as of end of Q2. Right? Most popular have been plain fixed annuities, in which you get a fixed amount of money, which is very much like a CD, pay a fixed yield. Fixed index annuities, in which the payout is linked to performance of stock index, right? Second quarter total were highest at 77.5 billion. Let me just go to what's an annuity is, right? Before we dive deeper into the numbers. So if we haven't purchased any annuity, or if we haven't been approached by someone who is selling you why you should invest in annuity, and I think you should always listen to all kind of investment opportunities. There are pros and cons of every type of investment opportunities. The idea is to understand it enough so that maybe you can have a more better conversation with the financial advisor or whoever is actually showing you various annuity plans. That's the whole intent. It is not, my intent here is not to tell you it's good, bad, or ugly. I'll present some of the facts that I have learned. You can make a decision. It's maybe good for you, or maybe depending on who you are, it might be bad for you. At least you'll have an information so that you can have an educated conversation with before you buy an annuity. That's the whole intent. All right. What's an annuity? It's a contract between an individual and a company. That's what an annuity is. It is mostly sold by an insurance company, but it behaves different than an insurance policy. So when it comes to insurance, most of us are very familiar with a very standard insurance called as the term insurance. Then we add a little bit more on something called a whole life insurance. The third thing is called annuities. It's an insurance plus investment. That's how it is being sold, saying insurance plus investment. Insurance policy give money to heirs if your insured person dies. Right? That's the whole intent of why we want to have insurance. Right? If I die, or if anyone on which if the family is dependent on someone who is a bread earner for the family, make sure that the bread earner is insured in case of mishappening. In case that person dies, you can have some cushion, and that's what the life insurance cover is. What annuities does on top of it, it pays periodic payment to customers while the customer is even alive. Not only, so it means plain insurance, term insurance will pay if you're dead, pay to heirs, but annuities will pay me periodic payment, just like social security check, just like your CDs, even when I'm alive. Right? But it will stop, those periodic payments stop after the death of the customer. So why insurance company will sell annuities? The benefit of the annuities is, and this is why if you go and talk to your tax advisor, my first experience of and having a discussion with someone who was trying, who showed me annuity plan was, I will, I don't know, a few years ago, I was with my CPA to do the whole tax stuff. And I told him, dude, I have to pay so much tax. How can I save more? My 401k or IRA, we have a limits. So how can I save a little more tax? Then he told me he's got a financial planner. He will basically, I can go and talk to them in the same office. So I went and spoke to the financial planner. That's where the pitch was, that you can save taxes if you invest in annuities, which is true. There's no two doubts about it. The benefit is that the growth in annuities is tax deferred, means you don't pay the tax right now, just like traditional 401k or IRA. So if you have exhausted all other methods of tax saving, annuity is one another method. We have a limits on how much we can save in 401k. I think this year it is about $20,500, somewhere near that. IRA also has a limit, but annuities has no limit. I can sock in 100k in annuities if I want to, right? And defer the taxes on, and don't have to pay those taxes on those 100k. All the taxes will be deferred, just like in 401k. So you can enjoy the growth of money without paying taxes for now. And that's the biggest selling point. If you go and talk to your CPA, tax is obviously they are CPA. They are not legally allowed to give advice, but they can send you to someone who will tell you that in annuities is a form which is being used by rich people to stag in more and more money for retirement and not pay taxes right now. Right? It is effective to save taxes, but is it an efficient investment? Right? So we'll review the process, the pros and cons, but let's understand some terms around annuities. Right? And this whole stuff is so complicated. If you sit with someone, financial planner or insurance agent who is selling annuity, you'll see so many plans, so many terms and terminologies. It's easy to get confused. And you get 30 minutes sitting and 1 hour sitting, may not be able to grab everything in that. So let's see if I can help you by giving you some overview, so that you understand and can have, we can use that 1 hour with a planner for, better purposes, to have more effective discussion than just trying to understand annuity. Different classifications of annuities. One classification based on how many lives is it covering. Is it single life or is it joint life? Right? Single life means you'll get the returns. So annuity is basically you give them money and the company will start giving you regular payouts until that person dies. So single life is until that one person dies. Joint life is maybe, if I die, I do want to make sure my spouse has got regular income. In that case, you buy a joint life. So the annuity payment will continue as long as one of the person is alive. Right? So one of them dies, the payment doesn't stop. Periodic payout will be less. So the payout means what's the amount that in annuities will pay you. The amount will be less in case of a joint life. Right? Because the company has to now cover lifespan of more than one individual. And they have all the actuarials, they have all the statistical data looking at me, my age profile. They know, I'm buying this annuity at 65, probably I'll live at maximum 20 years. A male from this ethnicity maybe live, I think from my ethnicity, maybe 75, whatever it is. I don't know. But now if you got another person you want to cover, they may live up to 80 years, 85 years. So insurance company has to cover the extra payout. So the regular payout in case of a joint life will be less. Another classification is based on when the payment begins. Right? Some annuities are immediate annuities. payout will start immediately. Now, I pay money to money to insurance company, I pay lump sum to them. Let's say I pay $500,000, and I'll start getting return immediately. So you pay money to insurance company, they start paying you back from next month until you die. Another one is called deferred annuity, in which the payment will start sometime in future and will continue until you die. Now, basic math is immediate annuity payment will be less than deferred annuity. Again, the company is not going to pay from their own pocket. Right? So if they have to pay for you longer term, the each payout will be smaller. Third type annuity payment is how the premium is paid. Right? Single premium, like we just talked about, that you got 100K, you just pay to that company and say, okay, I want an annuity for this. Or it will be periodic payments, generally monthly premium, or you can pay at a yearly. Right? Now, immediate annuity is always single premium. Right? Because if I want my payout starting next month, I can't defer saying, okay, it can't be a deferred annuity then. Saying, oh yeah, I'll pay my premium late, I'll pay my premium on periodic basis. It can't be periodic because the insurance company wants to get all the money if they have to start paying you from next month. So immediate annuity is always single premium. They would want to protect themselves. That if they're committed to pay you $1,000 per month, they want to make sure that anything that they need for the rest of your life, they got all the money up front. Deferred annuity can be single premium or periodic payment, but mostly it is a periodic payment, means you'll get it. You will pay to insurance company at a regular intervals. So far we covered single life, joint life. Immediate means you can start to get a payout immediately. Deferred means payout will be after some time. Hey, I'm still working, I don't need a payout right now. Pay me after I retire, after 10 years. Okay. How I pay the premium? If I pay a premium upfront, it's a single premium or periodic one. Now, this is where I think, yeah, these are newcomers. Okay. Few more. Pure annuity is just like Social Security. It's like your CDs, in which if you die, the payout die with you. Your heirs don't receive anything. No beneficiaries. That's a pure play annuity. So if you die sooner, before consuming all the money you put in, the insurance company will keep the bounty. Say you give them 100K and you want to start your annuity 5 years later. All right, you started getting money, and let's say you get $1,000 per month. Right? In first year you got $12,000. Next year another got $12,000. Anything happens, people come under bus, you die. So the remaining amount so you only got $24,000. $76,000. Company will keep it. Your heirs get nothing. Okay, that's called pure annuity. Refund annuity, you will stipulate that the account balance will be paid out to beneficiaries. Right? Example, you paid $1 million into annuity, started taking 100K payout at 70, you die at 72, beneficiaries will receive money until the whole $1 million is paid out. So you put in $1 million, $1 million will be paid out. Any growth will be kept by the company. Any growth in that, you paid $1 million and starting payout at 70, say, you are 60, so $1 million you paid out. Now the company has got $1 million, they start paying out at 70, that million could have become whatever, or could have gone down, but generally, if they're investing properly, could have become $1.5 million in 10 years. At the end of this, only $1 million goes back to your heirs, nothing more. Okay, so essentially, the insurance company took it from you, and now they're returning back that to beneficiaries. Right? Then there are some variations of refund annuity. It will pay for a specific number of years. Means they'll pay me not for my whole life, but if I'm starting that annuity at 70, I might just say, I don't think I'll live after 80, or even if I live after 80, probably I won't need that much money. I might be in nursing home anyway. So maybe just pay me for 10 years. Right? So those are different variations. Pure annuity has highest monthly payout because, yeah, if you die after leaving $1 million to insurance company, if you die sooner, they get everything. But it's also highest risk. Right? For us as annuity holders, it gives me highest monthly payout, but it's also at a highest risk. What if I die just after a few years starting annuity? Insurance company gets all the money, my heirs don't get anything. Right? This was an interesting point for me. And maybe someone who's bought annuity can confirm this. Annuities are not based on health conditions. I know your life insurance is, go and taking life insurance outside, not through your company. If you're in a company, you're taking a life insurance, you don't have to go through because they come in a group plan and all that stuff, right? But if you're not through your employer, if you're going and taking a life insurance on a personal basis, like I had done, I had to go through a health check, right? But what I heard and read about is annuities are not based on health conditions. Why? Because there is not much risk for the company. All these goody things, probably from a company perspective, issuing annuity, they have a very less risk, right? So they don't even have to check your health conditions before issuing annuity to you. The risk is not big. Now, based on amount of payment, right? You got a fixed annuity, you got a variable annuity. Again, different type of annuity. Fixed is based on fixed interest rate. Someone asked a question. It's like a CD. Yeah, if you're buying a fixed annuity, it's a CD. It is specified in the contract. I'll give you 3%, 4%, whatever. These were very popular when the interest rates were higher. Now, in 2022, this is again gaining popularity because interest rates are becoming higher now. But, since December 2019, interest rates were at bottom prices, right? As of December 2019, or even as till, let's say, till 2021, interest rates were bottom out, right? 1%. Doesn't make sense to buy an annuity for just 1%. Variable annuity is where the rate of return is determined by the performance of investment products underneath it. So this is where you mix your insurance and investment. So the insurance company will invest a portion of it in mutual funds or wherever they want to invest, and the performance will be impacted by the stock market, right? And this will be more expensive than fixed annuity because, more things you add, it will become more and more expensive. Mutual funds will charge you something, then insurance companies will charge a fee on top of it because they have to find a mutual fund and all that stuff. Third is you have an index annuity, which is tied to a performance of, some index. They came up with, again, but generally it is tied to a performance of a stock market index. In 1990s, stock markets were already super high, so they were not attractive. So the fixed annuities were not attractive because everyone will invest money in stock market when your interest rates are lower and market are higher. So the insurance company is saying, we'll come with the index annuity. It is just like a variable annuity. Most of the annuities are indexed to SPY, which I guess we can do ourselves. If you want to invest in SPY, you can go and invest yourself. Why you need insurance company to do it? Variable annuity will invest in mutual funds, etc. The latest one, companies will keep coming up with the products because these are very profitable, is something called as a registered indexed linked annuity, or RILA. Which is built for growth and has a cushion under losses. Now, if you look at this index annuity or variable annuity, in 2022, they won't be giving any returns, right? Because if your investment is based on, depending on, then there are different variations. Variable, you could say, I want 50% of it is in fixed, 50% is based on stock performance, or 25% is 1% payout, and rest 75% of performance will come from variable side. But 2022, markets like down 20%, Nasdaq down 25%, was down more than 30%. So those who had these variable annuities or index annuities are feeling the heat. They're not getting anything because there is no no positive return from the markets. So insurance companies came up with a new stuff called registered index linked annuity, in which it is for investors who fear losses but need stock returns to keep the nest egg growing. I want to invest in stock market, but gosh, the market has gone down 20%. How do I protect myself without giving all the upside? Right? One is, okay, take money out of stock market, put it in a fixed annuity. A fixed annuity will offer me whatever, let's say 3%. I mean, that's a 10-year treasury yield. So that's why I'm picking up that number. But what if within the next decade, stock market doubles in the next decade? Right? So I want to have some cushion plus some growth. There we go. New product. RILA provides various level of protection on the downside, usually 10% to 20% of market losses. Means if you invested in, take an RILA annuity, your losses will not be more than 10 to 20%. Plus a cap on the returns on index. Right? There is no free lunch. If you're putting a cap on the losses, you're getting some help on the losses, you have to give up something on the gains. Right? So the current caps allow for significant growth when the market perks up. So yeah. So this is another company which offers annuity, Lincoln National Life Insurance and Metra Life. A quote from them is, their RILA will absorb first 10% of index losses while capping the return at 20%. Means if market is falling, first 10%, you don't have to worry about, they will make you whole. But the downside is, if the market goes higher, you don't get anything beyond 20% growth. Right? If you think 60-40 portfolio, 60 isn't working, stocks are not working. 40% isn't working either, bonds are not working. So that's why he says that nearly 20, because S&P is down nearly 20%, bond market is down to 10%. So annuities had gotten more attractive as a solution on both sides of portfolio, especially these annuities. They offer a buffer or a floor on the downside. Right? If you look into RILA, look at their structure. Buffer means first 10% of the loss is covered by insurance company, whoever is offering this. Anything beyond that is customer risk. Means, let's say the market is $100, S&P 5 is $100. I bought this annuity. S&P goes down to 90. I have no change in my profile, no change in my peers, nothing. my investment will still stay the same. My corpus will still remains the same. The insurance company will cover any losses up to 10%. Market falls down 15%, or remaining 5% will impact me. Other thing is floor of 10%. Means first 10% loss is my responsibility. Anything more than 10%, say market has gone down 50%, 30%. 30% gone down multiple times. Market goes down 30%. I only have to worry about first 10%, which will go from my pocket. Everything else is covered by insurance, right? It's just like buying a put option. You buy a put option, you pay a premium, right? Then there's another one is a cap, means on the upside, what if the market goes higher? Most of these RLIs have a cap of 20%. Now, interesting thing when I was reading about it is that it doesn't include index dividends. So you'll say if you were investing in S&P 500, you also get those dividends. If you invest in an RILA, which is indexed to S&P 500, your returns will mimic S&P 500, but you don't get any dividends. The reason we don't get any dividends is they don't invest in S&P 500. They invest in derivatives, which will simulate stock market returns. Now, because we talked about options, been talking about options for years, let's see how insurance company do this, right? Going back to this is what we call as a synthetic stock position, right? SPY. Oops. Say I want to own, so 400, let's say 1250, right? We'll continue with our previous example. I gave $500,000 to insurance company, which is equivalent to, let's say, S&P 500 as 400, not 404. It means 120 units of S&P 500. You buy, that's equivalent to $500,000. Now, if me as an individual, if I buy these S&P 500, market goes, S&P goes up, S&P goes up, I make money. It goes down, I lose money. But in any case, I still get the dividends that come from S&P 500. Now, as of now, what's the dividend yield? Is, let's say, close to 2%. Generally, is 2%. Right? So I still will get 2% as a dividend if I just invest in S&P 500. If I invest in RILA, you don't get any dividends. So what RILAs do, because they don't invest here, what they do is basically they will have a synthetic position, which means they invest in the derivatives. Let's say, how do we simulate that derivative? Say, go out. Say you bought a contract for 1 year annuity. Let's go to September. So I'll put call. There we go. Now I've not bought any stock. All I've done is I use derivative to simulate the same stuff. S&P 500 goes higher, I make money. S&P 500 goes lower, I lose money. If you look at it, it's almost overlaps. The return profile will overlap as if you're holding the stock, right? So this is what insurance company will get into create synthetic positions. But if you deal only with create a synthetic position to mimic the market performance, you don't get dividends. You only get dividends if you buy the stock. If you buy call option, you don't get dividends. So what next? Now, the other thing of RILA is what they'll do is, remember, they'll give you let's say if I want to buy an RILA is floor of 10%, right? What they can do is go back, look at, oh, sorry, that was the correct one. Look at a floor of 10%. S&P is at 400. 10% lower will be what, 360, right? So I buy a put option at 360. There we go. So what I've done, I created a floor at 360. Anything less than that, my overall portfolio doesn't change. My value of my portfolio doesn't change. I have to bear the losses only from there all till 360. After that, no further losses. Right? But this doesn't come for free. What insurance company will do, they'll cap the upside. Remember now, if you look at an upside, if S&P 500 goes keep going higher, if it become 550, my portfolio value is 1760. You know, if it goes higher, I continue to make money. What they're gonna do is use another derivative to cap your upside at 20%. Say it's 20%. 400, 20% for 400 will be another $80. Say 480, where is it? There we go. Oh, we'll be selling a car. There we go. So if I add all these things, this is what your portfolio in insurance companies' books will look like. Your upside is capped at 20%. S&P continues to go higher. You're not gonna. So red side shows what's your end, value of the portfolio is. You don't make any money beyond 480, beyond 20% gain, but you don't lose money below 360 also. So this is what RILF is. It's nothing but, I talked about it multiple times. We do it often. This is one of my favorite strategy when the markets around like presidential elections, when you don't know what's going to happen in a options world. This is called collar strategy. Means you buy a put and finance it with selling a call. So I have bought a put 10% lower than market price, and I sold a call at 20% higher than market. Right? That's all it is. The question is, can you do it yourself? Hell yeah. So, and to do this, RILAs again are super expensive because they are a little more complicated. But if you understand what essentially they are doing, they are not gods. I mean, they don't have any pot of the gold. They don't have a capability to find a pot of the gold at the end of a rainbow. And specifically, they do mention they invest in derivatives. That's essentially what they'll do. Is put a collar around your position, which anyway, we can do it any point of a time. So this is RILF. Nowadays, especially this year, this is getting a lot of attention, because if you tell someone your losses are covered after 10%, that person is already half sold. I don't have to worry about anything below losing more than 10%. Great. But then say, yeah, you can also enjoy the growth, but won't grow more than 20%. Still fine. At least I have an opportunity to grow my portfolio up to 20%. And so no wonder this is now becoming more popular. This new product has been introduced. So that's a RILF, or sorry, RILA annuity. All right, any questions? I know we talked a lot about different annuities. So far, anything that it could be, it's sometimes a head spinner. And imagine you hearing for the first time when you're sitting in front of an advisor. Any questions? Anything you want to share of your experience with annuity, if you hold one? All right, let's moving on to the fee. Different annuity types come with different costs. Generally, the more complicated, the higher the fee. Same is the case with insurance product. Plain simple term life insurance is the cheapest one. You add your additional stuff, like you add another riders to it. You add a whole life stuff to it. It becomes more and more expensive. Same is the case with annuity. A fixed annuity is the simplest of them, will have much lower cost than a variable or index, or now we can add here, or RILF, RILA annuities. SP asks, what companies provide RILA? I don't know. That you might have to Google. Same goes for addition of riders. More riders you add to it, make single life to joint life, make it long-term care, add your payouts, some minimum guarantee of payouts. Moment you keep on adding the stuff, become more and more expensive. Average fee on a variable annuity is 2 to 3%, and it can be more than, that's the average, but majority of them are close to 3% or higher. So that's a fee that you paid. The bigger question is, are you getting compensated for that, paying that fee? That's something which I have little concern about, is the return that you get from annuity is very muted. And that is why they sell, like companies sell it, push it through, because these are way more profitable for companies than they are for annuity holders. Right? Often these costs will not be apparent because they'll be built into the fine print. So important to understand the contract. This is not the contract which you can, this is not the website where you don't even read it and just say, I agree. Some of these annuities are irrevocable. Once you got into it, some of these contracts are irrevocable. You got into it, you cannot come out unless you pay hefty fines. So very important that you read through the whole contract, understand what the fee you are paying, ask a lot of questions. What additional stuff do I need to worry about? What additional fee I have to pay? Okay. So based on my understanding, annuities pay pathetically. That's why they are very profit making for these companies. That's why they push it a lot. You can be better off managing money yourself, but that's not, also there's a cost to that, right? You may not want to. You may not feel comfortable with it. Right? You may want to spend your time somewhere else, right? When you coming here, spending 2 hours, two and a half hours every weekend, it's an investment. That's a cost of managing your own money. Nothing is free, but that's a cost you have chosen to pay for so that you can manage your own money. Insurance company will tell you that you can take a loan against this cash value. And this is coming because I actually spoke to one of the person, right? I was telling you from my tax person. So they told, I can take a loan against whatever is in my annuity that serves as an emergency cash. But I'm like, I'm taking loan against the money which is mine and paying that interest to insurance company. It doesn't make sense. It was me who put in the money, and I'll be taking the loan against the money which is mine, and then I'm paying interest to the insurance company. But you have to think through all what they're telling you. Insurance company will keep money if you die, unless you add those riders. Investment in mutual funds or anything but if you directly invest in mutual funds, right? You're saying, oh, I'm not comfortable in buying stocks. Maybe buy mutual funds. But if you're not take an annuity, but you directly invest in mutual funds, all that will be passed on to your heirs. But not if you're taken a pure annuity. Heavy fee and charges are involved in it. That's why it's so expensive. You pay 3%, mortality, expense charges, cost of underlying. Annuity once chosen is difficult to change or get out without paying huge penalties. If you add a rider to it in terms of allowing you to change, you're going to pay huge fee for it. So there are many cases, if you Google or try to read on how people got swindled into signing up and buying an annuities, which they didn't understand. And then they realize that, oh, this is not at all making any money for me, but they just couldn't get out of it. Many of them are actually irrevocable. Right? So person who understands investment can do some basic investing. Doesn't make sense. Why pay insurance company to do it when you can do it for yourself? This is not like you don't do your dental work on yourself, but that's something is difficult. With all the instruments available in the market, investing yourself is as simple as just making a change in your stockbroker profile once, and they'll invest continuously for you. Don't have to pick any companies. Pick the same S&P 500 index which these annuity companies pick. But the beauty of it is, if you die, the money goes to your heirs. You get dividends. You don't have to pay any fee. But so why many advisors sell this? Most of the time, people selling are not advisors, they're insurance agents. But if you talk to someone, they'll tell you, I'll send you to a financial advisor, financial planner, and they'll tell you how you can save money on taxes. And then when I talk to them, they'll talk about annuities. They push this because they get a huge commission on it. It's all incentive. It's all based on what the incentives are, right? If you get lot more money by selling annuities than by selling life insurance, as an insurance agent, I will sell this. So the person who was guiding me through the annuity plans, I asked her a question. I mean, are you fiduciary? Are you legally responsible to show me the plans which are more beneficial, which are the most beneficial to me? I asked, are you fiduciary? She said, no, she's not fiduciary. Then I have my own doubts. How do I make sure that you are working in my best interest? If you're legally, you're not a fiduciary. Right? So they are insurance agents. They work for their own favor or for the company. They're not fiduciary. Ask those people, how are you getting paid for this? Are you on a fixed fee base? Or are you getting a commission by selling this? So that will tell you a lot about, why a particular agent is selling a particular product. It's all based on incentives. What are the other options? If you don't want to do annuity, but you want some monthly outcome, you want a monthly payout, right? It's just like, it is very comforting to know that I will have a regular stream of check coming in my mailbox, right? I don't care where the market goes. I don't care what happens, but as long as I can keep getting a regular payout, that's a very comforting. That's the biggest selling point and very comforting for people. You can invest in CDs. Nowadays, I mean, you might find a 5-year CD which is paying 2.5% to 3%. You can create your own CD ladder or bond ladders. Right? Again, bonds are you can find treasury bonds that are paying 3% plus. You can create your own ladder, which in a way in which it will continue to pay you monthly payouts or regular payouts. Right? You can invest in high dividend yield companies. Right? Dividend aristocrats, which will give you regular dividend stream. Or more savvier, some of you, I mean, I use regularly is, you can also use covered calls. There we go. PJ, thank you. I hope I mean, I have nothing against it. I'm just looking at the incentives. So you have a better information on this one. Feel free to share it. As for me, who can manage your own money, that's why I've not bought annuity. When it does make sense to buy annuity, when you don't want to take a hassle of managing your money, right? It's not everyone's cup of tea. Most of the people don't want to do it, and perfectly okay. Uh, it's it's like any other trade. Not everyone is expert in all the trades. If your partner is not financial savvy, then annuity makes sense. Now, this is one reason why actually I might buy some annuities. Right now I'm healthy. I think I'm okay. I'll survive as long as I don't come under the bus. But this is one reason why I actually think of buying annuity, because my partner, she has no idea about the markets, right? She stays away from it. How do I make sure that she can get a regular payout once I am gone? Number two, the money is not in her hands, and she doesn't know anything around the markets, so she won't be able to pick up bad investments, right? Then in that case, she can't get swindled. I basically buy a big annuity, hand it over to insurance company. I understand it is costly, but in this case, my objective is not to get a cheaper returns, or it's not to get a return at a cheaper or a less cost. My objective here is to assure that there is a return, right? And that the money cannot be misused by someone. That's perfectly another reason why I would want to buy an annuity. This is one where I actually might look at, like I said, I don't have any now, but this is one area where I might go and, buy that annuity. You have a guaranteed money coming in. Only thing is, I probably can maybe build a bond ladder or a CD ladder. My spouse may not be able to, right? So this is no hassle free until you die. It's a good proposition, good investment to do for that purpose. Is like your pension. It will be with you. It's a good enough for your partner. It will be with you until you die. You'll continue to get this amount of money. Doesn't care that the market is on fire, or wherever S&P has gone. You don't even have to worry about it. Very valid, perfect reason for buying an annuity. I don't know. These are the two biggest reasons I think if one wants, should invest in annuity. Anything else? Yeah. So when we talk about high yielding opportunities, so we look at some of these are given the fact that where the markets are, even along with the annuities, the dividends have also seen most returns, right? New cash coming in the first half of 2022. Same case, same logic is people are comfortable in seeing that we want to get a regular monthly or periodic income through dividends. Every quarterly, you'll get a dividend check. Right? So some of the high yield dividend tickers out here. Then there are, again, apartment REITs, etc. These all pay you dividends. So these are some of the other regular income or dividend stream avenues, other than using combination of options or bond ladder or a CD ladders, etc. P. says peace of mind and guarantee life. Exactly. And at some part of a time, this is the most important reason, saying I don't want to deal with the markets. I just want to go fishing in the sea. I have no connections. At least I want a guaranteed income and peace of mind. Monthly yield from annuity taxable, I don't know. Maybe P-Shank, if you can talk more about it. Again, I'm not a insurance agent or a financial advisor, but I do want to read about so that I know, what these things are, and then can have a more intelligent conversation with an agent. Right? Do my homework before, little bit before, to understand how these instruments work. Every instrument has got a pros and cons. So hopefully this give you insight into all areas of a different type of annuities. I might have missed some, but hopefully you get some idea about it. Okay. Welcome, Sachin. What is the difference between VYM and VIG, high dividend stocks? Let's see what those holdings are. I have no idea. VYM. And what's the other one? VIG. Again, every dividend, these ETFs have a different objective and they invest based on firms. So firms are ranked by forecast dividend of the next 12 months. Those in top half are selected. So they are looking at next 12 months, who's going to give those dividends. Then they'll basically pick up the top 6. Come on. So you should look at how they are selecting these. So they'll looks like VYM looks at the next 12 months forecast dividends. What VIG look at? So this is a passively tracking, and it tracks what dividend growers index. So what is dividend growers index? So passive tracking means the fee should be lesser. Okay, so dividend growers index has got the companies. Let's see. Why guess? Let's see this. So this is the company that increased their dividends every year for the last 10 consecutive years. But it excludes the top 25% high yielding companies from eligible companies from the index. So there is always some nuances to it. So this will exclude the 25% highest yielding eligible companies. It could also mean those highest yielding eligible companies could be high risk companies as well. Your yield has gone up because maybe your share price has gone down. Maybe your business has gone down. That's why the share price has gone down. It means that you may not be able to sustain that yield. That is why they probably take it out. Again, I'm just guessing, right? That's why they exclude it. And the other one is looking at your future looking one, which is will be providing the highest dividend yield in the next 12 months? What was that? 12 months. Ashish says, I joined like timely discussion on annuity. I was discussing this about my co-worker recently. Annuities are back in discussion. I mean, annuities are back because of what's happening in the market, where bonds are not working, stocks are not working. Annuities, like P-Shank told, gives you guaranteed and a little peace of mind. But all you need to do is to understand the different tenets of annuity and what you are giving. There's no free lunch. What you're giving in terms of for that peace of mind, and then you can decide, is it worth for you or not. So that's all the objective is. We covered market health. Yeah, we went through the markets at the start of the session. Now we are almost at the end of session 12:28. Any other questions? So from a dividend perspective, again, I will. Few things that you need to look at. Number one is what the composition is. Number two is what the expense ratio of that ETF is. So, and then if you have a little more savvy, you may want to look at liquidity, you may want to look at whether it's optionable or not. But two ways thing is be aware of what the composition is, because there are many different type of dividend companies. Like if you're looking at high yield dividend companies, that means you run a risk of the yield may not be sustainable. You can look at aristocrats, which means they have been increasing their dividends for last 25 years. Every year means there are big companies, sustainable business. The yield may not be that high. It may or may not be optionable. So just don't go by the ticker. Look at what's the methodology by which they pick up the dividend stocks, and what's the expense ratio. 2% expense ratio, I'm like, forget about it. I'll just do it, pick S&P 500, etc. Is it possible to connect offline, or you can share an email ID to connect offline? Yeah, I mean, I can share my email ID. This is my side gig email ID. This is not a company as such. I just have my website. But yeah, I do have an email ID. We can chat on that. Do you have any info on REIT ETF investments? So I did this, again, not mine. This is I picked up from Barron's. So Barron, I think I talked about it when we looked at high yield opportunities, because I came across a Barron's issue where they talked about a lot of high yield opportunities. From there, I picked up this apartment REIT. So, and again, those are different, like Avalon. So there were two things, right? So those REITs are divided into two areas. One is bi-coastal, means mostly around the coastal side. Sunbelt is on the, basically, if you want to get exposure to Sunbelt area, and then these are the REITs which are invest in both. So there are some tickers for you. Again, no recommendations. I'm just sharing the data. Dividend yield of 3.3%. That's good enough. But again, if you are to evaluate yield, you have to look at funds from operations, right? FFOs, not the net profits. So there are different ways to evaluate different type of companies, right? When you're evaluating, looking at the strength of a company, generally look at net profits, right? But when you're looking for a REITs, its focus is on FFOs. VYM has 3.195% yield, whereas VIG is 1.85%, because VYM, again, we'll look at how they do the selection and what the cost is. And there is no free lunch. Now, how many of them are actually optionable? So I only do SCHD because that is optionable. And when I say optionable with a decent liquidity. I mean, if you look at this, a 300 volume, it's not the best bid-ask spread tight, but maybe 10 cents, 15 cents, 20 cents wide. Not the highest liquidity. Liquidity beyond a certain strikes dries out, but something better than nothing. This is Dividend Aristocrat. The another one very well known from, I think, Noble is from ProShares. Dividend Aristocrat. The only reason, only reason why I've not selected Noble, or there is one from Vanguard, is options are pathetic, right? So again, if you're not worried about options, you could select any of the Dividend Aristocrats. I went with the one of our decision-making factor was I want to reduce cost basis on top of it using options. So depending on what's the factor that you have, the decision-making could be different. Right. VIG has good options. VIG. a dividend appreciation ETF. Yeah, not bad. Volume is little lower. What's its expense ratio? But this is dividend appreciation. So I was looking at dividend aristocrat, but good to know. VIG is another ticker. Dividend aristocrat is companies that have been increasing their dividend for 25 years. It means the only way you can increase a dividend means you're actually making some money, because that's where your dividend comes from your cash flows. So, but VIG is dividend appreciation. Maybe I should, let me take a note of this. Little riskier than aristocrats, but yeah, not maybe good to add it to vehicles. Alrighty. Yes, that's it for today. Thank you for spending what 2 hours 30 minutes. Like I said, during annuities, there is a cost of do it yourself, and this is the cost, or I would say that's an investment on do it yourself. And I appreciate you investing every week 2 hours plus with me, and learning about what the market is, teaching me about some new things. So thank you. Last minute question before we sign off. All good? Alrighty. Cool. Thank you everyone for joining in, and we'll talk again next week. Have a wonderful rest of the week.